Welcome to the Byte-Size Brief. Today we are putting ASML, that's ASML, completely under the microscope. Let's get into it. I mean, imagine you're building a massive, like 20 billion euro semiconductor factory, right?
Okay.
You've poured all the concrete, you've assembled thousands of engineers, and you've mapped out literally the most advanced supply chain on the planet. But your entire operation,
Your bedrock.
yeah, the absolute bedrock of your success, relies entirely on a single bus-sized machine made by exactly one company on Earth.
Right.
And if you don't have that machine, your 20 billion euro factory is just useless. So listen, if you've been watching the markets around these April 2026 earnings, you probably have a serious case of financial whiplash. You saw ASML drop roughly 12.5%.
Yeah, a massive drop.
And that is despite the fact that this company operates a literal, undeniable monopoly in extreme ultraviolet lithography, or EUV. I mean, it is the company that makes the modern AI-driven world possible. So what is actually going on here?
Well, that is the exact question we need to answer today. Because the mission of this deep dive is to really look past that immediate visceral market panic. We're going to dive into the core mechanics of their business to analyze whether ASML is genuinely facing, a permanent growth plateau because of these massive geopolitical headwinds.
Right.
Or, and this is where the data gets absolutely fascinating, if the company is secretly transforming into a highly lucrative recurring revenue service monopoly, just hiding right in plain sight.
Okay, let's unpack this because the top-line data is just staggering.
Yeah.
I mean, the numbers are incredibly bullish if you just look at the surface, right? Full year 2025 revenue hit 32.7 billion euros. And the bookings, they are completely through the roof. They're sitting on this massive 38.8 billion euro backlog that stretches all the way out into 2027. So, when you have a guaranteed backlog of orders that massive, a 12.5% sell-off feels like the market has just entirely lost its mind.
It really does look contradictory on the surface, but we have to sort of cool the excitement and look at the hard data. The market didn't dump the stock because of the backlog. They dumped it because management issued a very stark warning. Basically, growth in 2026 is stalling, and the root cause of that stall is the China market.
Wow.
Historically, Chinese clients made up about 42% of their system sales. But because of these tightening U.S.-led export restrictions, Chinese demand is dropping aggressively, like down to around 20% to 27%.
Wow. That is a massive haircut. I mean, that is nearly half of their market share in that specific region just evaporating.
Exactly. It creates this 5 billion euro revenue hole over the next 3 years. And to understand why this is happening right now, we really have to look at the technology itself. What we've been seeing for the last couple of years is essentially pantry stuffing.
Pantry stuffing.
Yeah. Chinese fabrication plants, or fabs, they knew these export restrictions were coming, so they aggressively bought up older DUV, that's deep ultraviolet machines, while they still could. It was exactly like stockpiling supplies before a hurricane hits.
Let's actually clarify that for the listener, because the alphabet soup gets a bit thick here. DUV versus EUV. Basically, DUV, or deep ultraviolet, is the older technology, right?
You're right.
It uses a light wavelength of, I think, 193 nanometers. So you can think of it like drawing a blueprint with a thick Sharpie marker. You can only draw the lines on the chip so close together before they just blur into a mess.
Yeah,
But EUV, extreme ultraviolet, uses a wavelength of just 13.5 nanometers. That is like drawing with a microscopic, ultra-fine tip pen. You can cram billions more transistors into the exact same physical space.
That is a perfect way to visualize it. And because the West heavily restricted the fine-tip pen EUV machines years ago, China was stockpiling the thick marker DUV machines to build as many legacy chips as possible.
Right.
But now, that pantry is full. The storm of new export bans on those older machines is finally here, and that massive wave of localized Chinese demand is just coming to a dead stop.
Hold on. How does that actually affect ASML's stock price for regular investors like me?
So it creates a massive tug-of-war in how the company is valued. Value investors look at ASML trading at a forward PE ratio of around 27.5 to 30 times earnings.
Right.
That metric simply means investors are willing to pay roughly $30 today for every $1 of profit the company is expected to generate next year. For a hardware manufacturing company that is subject to highly cyclical spending from fabs, a 30x multiple offers basically zero margin of safety.
Right, and a margin of safety is essentially your buffer for being wrong, right?
Exactly. If growth stalls exactly as management warned, that 30x multiple usually compresses. The market decides, hey, we only want to pay 15 or 20 times earnings, which absolutely crushes the stock price even if the company is still entirely profitable.
But see, here's where I really want to push back. Because the bulls are looking at this completely differently. They are arguing that ASML isn't just some cyclical hardware stock-making, tractors or airplanes. They are an undeniable AI infrastructure monopoly. You literally cannot build the chips required for modern artificial intelligence without their EUV machines.
Yeah.
Period.
Yeah.
So using traditional valuation models that treat them like a standard heavy machinery company, it just feels totally incomplete.
And that is the absolute core of the debate. Do you value them on the 2026 geopolitical speed bump or the 2030 AI destination? Because when we look at the short-term shifts, the underlying momentum outside of China is intensely strong.
Okay, so compared to last quarter, what actually moved the needle here?
The dramatic quarter-over-quarter improvements are just impossible to ignore. Let's look at the hard numbers. In Q3 of 2025, net bookings were a very solid 5.4 billion euros.
Which is great.
Right, but then we hit Q4 of 2025, and bookings absolutely exploded to a record 13.2 billion euros.
Wait, 13.2. That is more than double in a single quarter.
Precisely. And the composition of those orders is what really matters. Of that 13.2 billion, 7.4 billion came from EUV systems alone. That is the cutting-edge fine-tip pen technology you mentioned earlier.
Wow.
On top of that, their gross margins actually ticked up from 51.6% in Q3 to 52.2% in Q4. So they are selling vastly more machines, and they are making more pure profit on every single euro of revenue that comes through the door.
And we know exactly what is driving that massive jump. It's the AI supercycle. You have these hyperscalers, the Microsofts, the Googles, the Amazons. They are spending hundreds of billions of dollars on AI data center.
Absolutely.
To build those data centers, you need just an ocean of high bandwidth memory, or HBM, and highly advanced logic chips. This is forcing foundries like TSMC and SK Hynix to rapidly accelerate their factory capacity. And to do that, they have no choice but to call ASML and place multi-billion euro orders.
And ASML clearly knows they're in a position of immense strength despite all the 2026 noise, because they capitalized on this quarter-over-quarter cash flow surge to heavily reward their long-term investor.
Oh, yeah.
They just announced a 17% dividend increase. But more importantly, they launched a massive new 12 billion euro share buyback program that runs all the way through 2028.
Okay, 12 billion euros in buybacks. That is a huge vote of confidence from management. But I have to ask, is this actually a smart move? Sometimes companies buy back their own stock at the absolute peak of a cycle right before the hardware market crashes.
Right.
Are they just inflating their earnings per share, or is there real fundamental strength backing this up?
It's a highly critical question. Buying back stock at a cyclical peak is a classic way to destroy shareholder value. But to truly understand why management is so incredibly confident that this isn't the peak, we have to look past the hardware sales entirely. The most fascinating dynamic inside ASML right now is hidden in the footnotes of their financials.
Yes. This is my absolute favorite part of the research we pulled. Everyone is so hyper-focused on the giant bus-sized machines shipping out the door, but ASML is quietly operating this wildly profitable services business right in the background.
They call it install-based management, and the numbers behind it are staggering. This segment grew 39% year over year. It is now generating roughly 8 billion euros annually. And the kicker: it operates at 60% gross margins.
60%. I mean, that is not a hardware margin. That is pure software company territory.
It really is. Install-based management now accounts for roughly 30% of their total gross profit. And it makes perfect sense when you understand the actual mechanics of the industry.
I've heard some people compare these EUV machines to Formula One cars because they are incredibly fast and need constant maintenance. But honestly, I think that's a terrible metaphor. An F1 car is just a vanity project. This is more like a razor and blades model, or better yet, a high-end commercial jet engine.
Oh, that's a good comparison.
Right. When an airline buys a jet engine, the manufacturer doesn't make their real money on the initial sale. They make it on the mandatory, highly specialized service contracts that guarantee uptime. Because if a commercial jet engine goes down, the airline bleeds money. With ASML, if an EUV machine goes offline, the fab loses millions of euros per hour.
That is a much more accurate framework, and it goes beyond just maintenance, actually. It's about performance upgrades. Customers are paying 15 to 20 million euros just for software and component upgrades. For example, the new NXE 3800E upgrade physically pushes the output of a machine to 220 or even 230 wafers per hour, Why does that matter? Because a fab's costs are largely fixed. The building, the electricity, the staff, you pay for those no matter what.
Right.
If you can squeeze out an extra 30 silicon wafers every single hour from the exact same machine, your own profit margins skyrocket. If you are TSMC and your competitor buys that upgrade, you have no choice but to buy it too, just to stay competitive on yield and output.
So basically, it's kind of like a software subscription you can't cancel.
That is the exact playbook. It is highly comparable to an enterprise software lock-in. The switching costs approach infinity because your entire multi-billion-dollar factory is literally built around ASML's technical specifications. And the company is aggressively leaning into this software and AI transition to deepen that moat. To prove it, they just became the lead investor in Mistral AI's Series C funding round.
Wait, Mistral AI. They're a large language model startup. I have to call a timeout here. Are they just slapping the word AI onto their press releases to pump the stock, or is there an actual mechanical reason a semiconductor equipment manufacturer is buying into an LLM startup?
I know it sounds like buzzword bingo, but the mechanical utility is profound. Operating at the sub-nanometer level requires unimaginable precision. ASML took an 11% stake in Mistral to integrate advanced large language models directly into their metrology.
Okay, metrology.
Metrology is simply the science of measurement. When you are measuring distances spanning just a few atoms, you generate petabytes of sensor data. An LLM can instantly parse massive logs of this optical inspection data to predict exactly when a laser or a mirror will degrade before it actually happens.
Oh, wow.
This predictive maintenance keeps the machine's uptime near perfect, which is exactly what fabs are paying those massive service contracts for.
That is incredible. So they are essentially double dipping into the AI boom. They sell the hardware to make the chips, and then use the AI generated by those chips to parse sensor data, which locks customers into these high-margin software and service contracts. It is a brilliant feedback loop.
It is a phenomenal business model. But if we want to be entirely objective, we have to discuss the immense physical and financial challenge sitting on their hardware horizon right now. And that is the rollout of high-NA EUV.
The next generation of machines, let's define the acronym first. NA stands for numerical aperture. In photography terms, a larger numerical aperture is like having a much wider camera lens. It captures more light from more angles, which means you can expose even finer, crisper lines onto the silicon wafer without blurring.
Exactly right. High-NA EUV systems are pushing the absolute bleeding edge of physics, and they come with an eye-watering price tag of 350 to 400 million euros for a single machine. The dilemma here is customer adoption. Intel is being very aggressive, buying up the early EXE 5200 tools because they are desperately trying to leapfrog their competitors and return to foundry dominance.
But Intel is just one customer, and frankly, they've struggled lately. What about the elephant in the room?
Right, TSMC. TSMC is the undisputed king of manufacturing, and they are explicitly delaying their adoption of high-NA until at least 2028. TSMC prefers to be highly methodical. They are stretching their current low-NA machines to their absolute limits using a technique called multi-patterning.
Multi-patterning. I've read about this, and the mechanics of it are wild. Essentially, because the older machines can't draw the lines fine enough in one go, TSMC is running the exact same wafer through the machine multiple times to get the required density. Think of it like trying to perfectly trace a highly complex drawing multiple times with a slightly shaky hand. Because at the nanometer level, if your alignment is off by the width of a few atoms on that second or third pass, the entire chip is ruined and goes straight in the trash. It is incredibly risky for defects.
It is risky, but for TSMC, that risk saves them from spending 400 million euros on a single new high-NA machine. They believe they have the engineering talent to perfectly align those multiple passes. And because TSMC is holding out, ASML is stuck in a margin trap.
Ah, I see.
These early high-NA tools being shipped to Intel are essentially very expensive beta tests. They haven't reached the scale required to be highly profitable, meaning these early high-NA sales are currently diluting ASML's overall gross margins. They need volume to drive down their own internal manufacturing costs, but they can't get volume until TSMC finally commits.
Okay, well, if high-NA is so incredibly expensive and complex that even TSMC is balking at the price tag, doesn't that open the door for competitors to swoop in with cheaper alternatives? What about Canon? They are pushing a completely different technology called nano-imprint lithography, or NIL, and claiming they can hit 5-nanometer capabilities by 2026. Or what about China's state-backed firm, SMEE, aggressively pursuing self-sufficiency because they are locked out of buying ASML equipment?
It's a highly valid concern, especially when you zoom out and look at the broader semiconductor industry shift. As chip architectures move away from traditional flat, planar designs toward complex 3D chiplet integration, the strict reliance on single-exposure optical lithography might shift. Fabs are continually reevaluating how they allocate their massive CapEx budgets.
Right.
This architectural shift potentially creates a narrow entry point for Canon's NIL technology in specific, cost-sensitive, high-volume memory layers where extreme precision isn't quite as critical. Simultaneously, you have China pouring virtually limitless state subsidies into closing the technology curve.
Right, but what does all that actually mean for ASML, ASM investors?
It means ASML cannot just rest on its laurels. It must aggressively defend its monopoly through sheer overwhelming scale. And they are doing exactly that. They spend over 4 billion euros annually on research and development alone. To put that in perspective, that R&D budget is larger than the entire total revenue of some of their competitors.
4 billion euros a year just on R&D. That is an impenetrable financial wall.
It is an incredible moat, and it's not just financial scale, it's vast physical infrastructure. To literally power this massive testing and manufacturing operation, they recently expanded a power purchase agreement with RWE to secure 130 megawatts of renewable wind energy from offshore and onshore farms in Europe. That deal runs all the way through 2038.
Wow.
When you are locking down your own private grid of offshore wind farms just to power your research labs, the barriers to entry for any competitor remain nearly insurmountable. Canon and SME might carve out small niches at the lower ends of the legacy market, but at the absolute bleeding edge of logic and AI chips, ASML stands entirely alone.
Okay, let's bring all this together. We've covered a ton of ground today. ASML is currently caught in this incredibly fascinating transition trap. On one hand, the bullish case is roaring, right? They are sitting on a 38.8 billion euro backlog. They built this 8 billion euro software-like services division, growing at 39% year over year, and they're fundamentally the bedrock of the AI supercycle.
Yep.
But on the other hand, the bear case is very real. They are staring down a rocky 2026 filled with geopolitical tariffs, a 5 billion euro hole from the end of Chinese DV pantry stuffing, and the serious margin-diluting growing pains of rolling out their next-generation high-NA systems before TSMC is even ready to buy them.
It is the definition of a complex transition, but I want to leave you with one final, entirely new concept to mull over. We spent a lot of time talking about their monopoly over the machines that build AI. But if ASML truly holds the singular key to the global AI revolution, we have to ask, at what point does a single company's monopoly stop being just a great stock pitch and start becoming a global national security risk? Not just for China, but for the West, too. Think about it. If one single ASML factory in the Netherlands suffers a catastrophic event, a fire, a grid failure, or targeted sabotage, the entire global AI race literally halts. There is no backup supplier. That reality might eventually force governments to intervene or mandate decentralized production, shifting the way we value the company from a traditional tech stock into something resembling a highly regulated global sovereign asset.
That is a staggering paradigm shift to think about. A company so crucial that its existence transcends the stock market and becomes a matter of global infrastructure security. All right, listeners, what's your take on the future of ASML? ASML. Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.